The market today posted its worst day since 2022, which of course was a bear market. So the question is it over? Is the dip over? Is the bull market over? Let's talk about that. I want us to look at a couple of indicators kind of in rapid fire. We'll go into more details on this on Bootleg Weekly. This is a fear and greed index. Now, there's the old saying that you should buy fear and sell greed. I've been a little bit careful with this dip. I have a video out that's talking about when to identify when to buy the dip, when to look at local tops and those sort of things. This dip was a little bit different. And going back to actually last Monday, I just knew that with the incredible volatility that was being introduced by the Oval Office in the market and some uncertainty in the global macro as well, it's a tough time for the markets simply because the market loves certainty and they're not getting that right now, at least not over the short term. And so as a result, 1 week later, here we are. We moved from fear to extreme fear. One of the lowest levels it's been for quite some time. We can see a week ago is at 18, and yet the stock market was at a higher level. Now you can see on the S&P 500, we've had quite a bit of a pullback over the last few weeks. Not too much as far as a shock to me personally. I posted a video on this as well, when to spot those local tops, and there was just a lot of greed and euphoria in the market. And in those times, the market can tend to ignore every single possible thing that's negative. And of course, in bearish times, it ignores everything possible that's positive. So we'll look at some of the positives. But a lot of this is simply just due to uncertainty in the market. And even in bull market cycles, it's not unusual to have a 10% pullback. We're just shy. We need to go down to 558 to hit that 10% pullback, which would be actually pretty healthy and normal for the market. Now we're a lot closer actually to a bear market in the NASDAQ. And as a reminder, that's when the index hits about a negative 20% from its all-time high. And a crash is considered when an index hits negative 30% from its all-time high. So looking at this, we can kind of ignore volume for a moment, but we do see that this was not a low volume day. It was not meaningless at all. Right down here, I want us to focus our attention on this. This is the relative strength index. I've talked about it a few times, but as a reminder, basically that looks at trading strength and strength rather in the underlying over the last 14 units of time. In this case, over the last 14 days. Now you can look at this on a hourly time frame, on a weekly, on a monthly, but most people choose to look at it on the weekly time frame. And when RSI goes below 30, it is considered oversold. We actually hit that today. When it is above 70, it's considered overbought. And you can see from these peaks and these troughs that a bull market can tend to exceed that overbought condition for a little while, but ultimately it gets pulled back down to earth. And you see just how almost perfectly it is bounced off this 30 RSI going back to October. Let's go a little bit further back though. And we can see there are places, even in a bull market, my head is in the way, excuse me. We can see places even in a bull market where we can go below for a little while, but not for long. And so I think that the RSI is indicating to us, unless we think that this is a bear market, that we are going into a major recession, which I don't think so at this time. I don't see any reason why to think that we're going to have a lot further pullback on the RSI. Even though you can see some temporary issues like that, it usually bounces right back, as does the price action, unless there's major divergence. So RSI indicator is telling me, hey, we might be near the bottom. The question is this the bottom or is this a bottom? And could we keep falling lower? I think it might actually be that we might get a bounce, a reprieve, a time where people are like, okay, good, maybe the worst is behind us. And I do think that there is a possibility of a further pullback. Now, the reason why I'm saying that is the market absolutely hates uncertainty. And until we have more certainty regarding certain policies from the United States, especially from the Oval Office, there may be more pain on the way. Let's look at a couple other charts too. This was a revision that the Atlanta Fed came out with for their GDP targets, going from positive, and a lot of this is from governmental revenue, but not all of it, to quite negative in just very little bit of time. They're not the only ones that have made revisions, but this has gotten the most attention by the market. And as a result, the market itself is saying, oh man, what if there's two of these negative GDP prints? Used to be, historically, that was considered a recession. In Biden's administration, we said, well, it's not really a recession. He did have two of these, although they were a little bit more shallow. simply because the workforce was actually pretty robust. And that's actually not the worst argument in the world. Like a normal recession, you'd expect both GDP being negative and a very, very weak job market. So I don't know that we'll get the weak job market or not. Having 2 consecutive quarters of negative GDP growth, that's a possibility in the short term, especially if the tariffs do remain and government revenue continues to slow down, or government expenditure rather, which is a big component of GDP. So, what's the good news? Where are we going long term? One of those pieces of good news is, of course, the U.S. 10-year Treasury note. The reason why that this is important to follow is that mortgage rates actually will follow off of that pretty closely. We can see year to date, we did climb briefly up to when Trump took over, we do see the 10-year falling. And this actually happened in a similar way, although not quite as aggressively in Trump's first term. He's mentioned the 10-year yield a number of times. Now let's zoom further out to 3 years. We can see that where the 10-year rate is, it's not particularly low. We're actually still inclining. This is very much intact. But as a 10-year pulls back, the 30-year mortgage rate tends to be matching this. Of course, it's going to be higher than the rates, but it tracks this more closely than what the Fed does as far as cuts. And so if we see continued weakness and concerns as far as recession in the United States economy, and also if we see a lot of people flying out of equities and flying into safe money like U.S. bonds, there's a lot more demand for that product. And all of a sudden, those rates go down. Now, what happens if we go below 4 or even into the 3s? That's happened, and usually that creates a surge in people refinancing loans, and it creates a massive surge in real estate. Real estate is still a very large part of the U.S. economy, and it's been very, very flat and stagnant. It was one of the worst years in a long time over this last year. If 10-year rates continue to fall as we get to 4%, as we get to 3.5%, even maybe 3% throughout the year, that's going to take a while. It's not going to happen overnight. Even if it's not for good news, that will unthaw and unlock the real estate market, which is very, very good for some companies like SoFi and probably Enphase as well. But overall, at the cost of recession, short term, not great, but unthawing and unfreezing the real estate market is substantially good for the economy. And so I think even though we might have 2 consecutive quarters of negative GDP growth, depending on what government policies come out, that things are not in tatters, at least not yet. Now, what about overall rates? Of course, the Federal Reserve had comments last week, and they talked about basically just doing nothing different at this point, but keeping an eye on it. But these are rate probabilities now for the end of the year. Now, as a reminder, the current rate is 425 to 450 basis points, which is right here. Right now, pretty much nobody, except for just a couple of people out there, are thinking we're going to stay the same. Few people see 1 rate cut, a few more see 2, and actually the consensus right now is 3 rate cuts, with a lot of people coming in at 4 as well. And you can see how fast it's shifted. This is really worth looking at. We can see that almost nobody was expecting even rate cuts down to 300 to 325 basis points in a month ago. Now it's up to 13%. And just 1 day ago, it was 6.5%. These probabilities can change in a hurry. Yet we've seen what's happened with the stock market. It's just been tanking, going down very, very rapidly. And even though we're not in a bear market, by no definition are we in a bear market. I don't think we're headed towards one. Right now, the market is pricing in pretty much no good news at all. It's kind of nice that earnings season is behind us. Any company that would be presenting in times like this, it could have the best earnings in the world and sell off completely. Speaking of which, Robinhood stock, yeah, it's one of those. If you believe that we're heading to a bear market, yeah, things are going to be rough for Robinhood, but man, it's looking juicy at these levels. I'm buying that dip. But for myself, on most other names, what I've done is I've consolidated away from a couple of names that I have less certainty on. That's Accelera and ironically Enphase, which has done very well ever since I sold it. That's kind of what happens sometimes. Rate cuts and unthawing the real estate market are very good things for Enphase, by the way. It's not unsubstantiated. Energy is also doing quite well, and it can do quite well in recessionary environments. But beyond that, I am slowly deploying my capital. I was a little bit more aggressive today in names like Robinhood, NVIDIA, also in HIMS. I bought last week through a cash secured put. Just one, just a small amount, but I'm nibbling here and there with a couple other names as well, slowly. This is a dip that I think might get juice here over the long term, but over the short term, we might see a little bounce here. Now, what I encourage you to do, if this is your first time going through something like this, you're newer in the market, all of us have been there once. I'm not saying that we're going into a bear market, but bear markets or times like this can be very good instructors and teachers. And so if you're seeing that you should have done something differently, perhaps chase less, perhaps not use leverage, which is usually really good advice. Don't use margin, or be very, very careful with it. Know what you're doing. Um, Going in less speculative names, being quicker to take gains, having some sort of hedge. Figure out what works well for you and gives you peace of mind. Myself, I'll continue to DCA into quality names. I've learned lessons from prior bear markets and on how to adjust during times like this. And I'm doing so. And as a result, you can see I'm a lot calmer than I was last Monday, resting easy. This doesn't faze me much at all, even though I am down year to date. Not fun. But let me know what you think in the comments. If what your strategy is at this time, what you're expecting as far as the short-term and long-term future throughout this year. Are there names that you're very, very interested in that you're getting into, or are there plays that you're getting completely out of? Let me know. As always, thank you for watching, commenting, and subscribing. Until next time, happy investing.